The 2021 stock market crash has been canceled, at least per the results of a new reliable survey. Now, I know, the economy's in shambles. Many well-known economists are calling for a market crash next year, but new information that's coming out tells us something much, much different. And in this video, I'm going to tell you what a very reliable market indicator is telling us. I'm going to tell you what history shows us and exactly how to play this, no matter what happens next year. All right, welcome back. If you're new to the channel, my name is Mark Moss, and the world is changing really, really fast. And if you're not paying attention to see these subtle shifts, you might not realize until it's too late. And since no one's coming to save you, it's up to us to figure this out and navigate this on our own. So if you like this type of information and you want to help me get it to more people, please just take a quick second and click the like button right now. And if you're not subscribed, hit the subscribe button and the bell notification. Okay, so today I want to talk about what changes I am seeing in the market and how it's starting to look like the big crash that everyone's expecting next year, like everyone's calling for, everyone's waiting for. Well, it might have just been canceled. And of course, how the heck can I say that, right? So before I dive into this, I just want to say real quick, if you're new to my videos, just know that the market and the market as in like the financial markets, it's not the same as the economy, okay? They're completely disconnected, as you can tell. How, we have record high unemployment, record high mortgage and rent delinquencies, but at the same time, we're hitting all-time highs across all the financial assets. So today, we're talking about the markets, the financial markets. And in the markets, we're seeing extreme bullishness. And we're seeing extreme bullishness at a level that's not really seen. We haven't seen in a long time. And I'm not talking about just the usual bullish behavior, where everyone's talking about stocks and they're all over the media and everyone's bidding them higher and higher. All right. I'm not talking about that. All right. What I want to do, if you're not new to my channel, I like to go back through history. So let's go back just about 30 years to look at one of the biggest bull markets that led to this massive blow off top. I love to look at this period in time. And so we'll go back to about the mid to late 90s. And that was during the dot-com boom, pretty famous. During those years, we saw tech stocks shooting up crazy. We saw them shooting up 100%, doubling in just a couple of days. In fact, the entire tech sector rallied about 250% in just the last few final days in that great late 1990s boom. Now, the reason why is really because of human emotion, all right? Where human emotions were really only motivated, as humans were motivated by only two things: pleasure and pain, all right? So we want to rush towards pleasure. So when we see everyone making crazy amounts of money, everyone's making money fast and easy, we want to rush to that. That's pleasure. We want to get that pleasure. We have FOMO. And so more and more and more people rush in, and it just drives that bubble up farther, and faster than you could imagine. Now, we also suffer from something as humans called recency bias. And what that means is that we tend to believe that whatever's happening now, we think will continue to happen. So if we're in a bull market, we think things are never going to stop. They're going to keep going up. And if we're in a bear market and things are going down, we think they're never going to end. They're going to keep going down. And so when you add these two emotions together, it gives us this level of confidence that basically just defies reality. And when this happens, it seems investors, they basically just throw caution to the wind. And today, it seems like there are more and more investors in the market than almost ever. And right now, all the stocks indexes, the S&P 500, the NASDAQ, the Dow, they're all hitting all-time highs. But I'm seeing something in the market that's a little bit different from what we've seen in other parabolic market moves, like during the run-up of the dot-com peak. Now, what's strange is it doesn't look like investors are thinking it's going to end anytime soon. Again, right? Recency bias. In fact, the level and specific sort of excitement, at least from this select group of investors, it's actually a good sign. All right. Now, it's a good sign for stocks in the coming months and maybe even in the coming years. So what am I talking about? So you see guys who are getting bullish right now, they're not your typical mom and pop investors like you and me. They are not the new batch of Robinhood day traders who are playing with their stimulus money, although that's certainly happening. But instead, I'm talking about what we typically call the smart money. All right. Now, these are the seasoned vets. These are the institutions, the big dogs, the Wall Streets. And usually they see the writing on the wall often better than most of us do because they have so much data, right? And right now they seem to be making some really big predictions that predicts that stocks could go much higher from here. So why do I say this? Well, You see, in this recent survey that came out, it's the monthly Global Fund Manager Survey from Bank of America. And the goal of the survey is to find out what the top people on Wall Street think about the current markets. Now, the survey reaches out to more than 200 mutual fund managers all around the world. And these managers, they have more than $600 billion in assets under their management. So they're pretty big, right? They're definitely paying attention and they're moving the markets. And the survey gives us an inside look at how they might be investing that money that they have, which is a big chunk. Now, questions on the survey range across all different types of topics, such as overall bullishness to the biggest tail risk that they see for today's markets. And when we look at this moment in time, it doesn't tell us much, all right? So it's just one survey, right? But Bank of America has been doing this survey for decades now, all right? And so when we look at the answers over time, then we can start to get a different picture, and the information that we see can be extremely useful. And the most recent survey was one of the most bullish surveys that was ever done. As a matter of fact, it was so bullish, it was titled, quote unquote, the full bull. And it was titled that just to mark the sentiment that it got from the survey, and because there were so many bullish results. And the survey thinks we're getting close to what they call, again, quote unquote, the full bull. Now, for example, one of the standout results this month was the percentage of fund managers that expect company profits to be higher in 2021. And that was about 85% of those surveyed said they expect company profits to rise over the next year. I mean, that's the highest rating that we had seen in the survey in over 18 years. Now, again, these bold predictions aren't a warning sign. All right. And when you look back at the surveys historically, we can see that in the past, it's actually signaled big buys in the moments for stocks. So, for example, back in the mid 2000s, stocks had been in a bear market for years after that dot-com, that blow off top. But Wall Street fund managers, they were starting to get bullish. And it turns out that the ultimate bottom for the benchmark S&P 500 index at the time came in October 2002. And then from there, stocks ended up going on a multi-year bull run. And so you can see what I mean on the chart that I have up on the screen, which shows the S&P 500 total return index. And again, this is a similar story played out over and over again. We saw it again at the depths of the financial crisis after the great financial crash in 2008. So after that massive crash in 2008, back to early 2009, the same survey went out to the same group of fund managers, and they were basically saying that they thought the worst was behind, that things were going to start getting better, that companies would start recovering from the crisis. And again, they got it right. They got the timing right, which is the hardest thing to do. U.S. stocks actually bottomed in March of 2009. The S&P 500 went on to have one of the longest bull runs in history, rallying more than 500% to its eventual peak in February 2020. Of course, we're still setting new highs at this point, so we can argue if that market structure has been broken. That's a different topic. But as you can see from the chart on the screen, you can see how this has taken off. Now, I know that I've often talked about, and you probably know that a lot of times when everybody's bullish, we typically want to take the contrarian bet. We want to be bearish, all right? But when this report from these fund managers come out, when they come out and they say that they're bullish, and they've often been right so many times, then we have to look at it a little bit differently. And like I said at the beginning, I know we're still dealing with a global pandemic, all right? But this crisis, it's going to pass, eventually pass, and that's exactly what these fund managers are betting on right now. But the question is, will they be right? That's the question, and I want to take a look at that. So is the market really ready to continue to shooting higher? Or are the economists on the other side, Harry Dent, Peter Schiff, Jim Rickards, they're all calling for a 50 to an 80% correction in 2021. Will they be correct? Well, the real answer is we don't know. And I hate to tell you this, but nobody does. It's not a matter of who's smarter. It's not a matter of who has better research, because everybody is taking guesses at this. So at this point, I'm giving it about a 50-50 chance that either side could be correct on this. So let me explain, all right? So economists like Harry Dent, they understand market cycles. They understand debt to income levels. They understand inflation, deflation. They understand what it means to the economy, right? They understand that. They understand the demographics. They understand how populations change spending habits as they go through life, right? They get all that. So in other words, they understand how a normal market, a natural market, how it should work. And I agree with them, right? They're absolutely right on how a normal natural market should work. But the problem is we don't have a normal market. Instead, what we have is a captured and a controlled market that's being completely controlled by the Federal Reserve. And it's controlled by the Federal Reserve and their ability to create and inject dollars into the system. So while economists like Dent understand what should happen, what they don't know, there's no way for them to know what's inside these 7 Fed governors' heads. And they don't know what's in their head and when and if and how much they're going to act. All right. But what we can do is we can try to guess by looking at who they are, how they've acted in the past, and what issues and problems they might be facing forward. So for example, in 2008, when the great financial crash happened, it was the first time we really saw the Fed jump into action. And they came into action quick, and it was kind of the first time we've seen QE, quantitative easing, and all this stimulus, and the Federal Reserve quickly added about $1 trillion to its balance sheet. All right, and they did that to try to save the economy, prop up the financial system and the markets and stuff like that. All right, $1 trillion. But fast forward to now, to 2020. And this time, instead of $1 trillion, it was automatically $3 trillion, a much bigger response. Plus, on top of that, we saw Congress jump in to help bring in the total amount of stimulus to fight off, the crash, the corrections, to more about $6 trillion. So what we can see is that they're far more willing to act, and not just act, but act big and act fast, right? They're way more willing to do that. And so because of this, many investors are now betting that the Fed is going to backstop the market. The Fed will do whatever it takes to keep the markets propped up. The question is, will they? Well, of course, we don't know for sure, but they have said that they will. They've told us that they will. And of course, their actions are saying the exact same thing. I mean, if you also look at it, why would they spend $6 trillion to keep the market from crashing just to let it go and let it crash now, right? Why wouldn't they continue to go deeper and deeper and deeper, right? Then we can see potentially other things that have happened. So we see potentially Janet Yellen could be added on as the Treasury. I talked about that in a previous video. You can see it up here to understand what that means. And in that video, I pointed out that why she might have been picked and what that means. And if you understand that, then you understand that, yes, more money printing is coming, and probably, like I said, in a really big and in a fast way. Now, we also know that if the Fed and the government stop printing, if they stop and decide not to do more stimulus, and they don't inject trillions into the system, into the markets, then the entire system's going to crash, right? There's no way the system can survive without continuing to pump money in, which is exactly what the economists like Harry Dent and crew have been saying. And they will be correct. But the question is, will they, right? Will they stop printing? Will they stop putting money in and let the system crash? And if so, why? Why would they do that? Is this what the Bank of America survey respondents are seeing? They believe that the Fed and the Treasury will do whatever it takes. And if so, is it going to work? Now, I believe they're going to continue to do whatever it takes, but at some point it won't work anymore. But like I said, what I think is at the end of the day, nobody knows. And I never try to predict the future. Instead, what I do is instead of trying to predict the future or guess, I look at things as probabilities. And I try to do this kind of like what the CIA does with risk analysis. So, we have different potential outcomes. And in order for either of those to come true, then this has to happen, this has to happen, or this, right? And so then I can assign probabilities to them. So let me explain how that works. So probably maybe 60 days ago, I was giving maybe a 65, 70% probability that there would be this big correction in the next 12 to 18 months, sort of kind of agreeing with Harry Dent and crew. And I was giving maybe only a 15% chance that there would be no correction, and instead prices would keep going higher and higher and higher. But over the last 60 days or so, a lot of things have started to happen that are starting to change the way that I'm looking at it. And now I'm starting to assign a higher probability to option 2, which is that we don't have a crash and things keep going up. Now, mainly, some of the things that I'm seeing is, like I said, with maybe the odds of Biden winning, Janet Yellen being in the Treasury. And so I can see the Fed and Treasury working together. I can see them being much more willing to act really fast, really heavy, and put more stimulus in, maybe more stimulus than we even need, and basically doing whatever it takes. So now I give almost about a 50-50 chance that we could crash, or we can continue higher from here. Now, as we continue to see more developments, I'm going to continue to adjust my probabilities to how I think this can play out. Now, I know for some, you might be thinking that I change my mind too much. I've heard it, right? I change my mind too much. I waffle back and forth. I can't make up my mind. I've heard it, right? I see it in the comments. But that's not how this works, right? That's not how this works. I don't try to predict the future, Rather, I'm just reading the signs. I'm reading the signs, and then I'm looking at potential outcomes, and I'm trying to assign probabilities of each thing, and then I'm adjusting my investments according to my own level of conviction. And you should be doing the exact same thing as well. Now, I'm also closely paying attention to all this new information that's coming out, all these new developments, and then I'm also quick to change my mind and my views as this new information presents itself and requires me to change my thesis. Now, I like this quote from the author Malcolm Gladwell. He said, quote, "I feel I change my mind all the time, and I sort of feel that's your responsibility as a person, as a human being, to constantly be updating your positions on as many things as possible." Wow, so that's a good quote from Malcolm Gladwell, and that's kind of how I look at this. I'm looking for more information. I'm looking to update my views as it comes available. Where does this leave us with our investments? Well, you need to see where you have this level of conviction. I'm telling you where my conviction is, but you need to find out where your level of conviction is on these assets. Do you feel more strongly that a crash has to happen for sure? Well, then move that way. Do you feel that no, there's not going to be a crash, they're going to save the day? Then you need to adjust accordingly for that as well. Now, for stocks, for gold, gold miners, Bitcoin, cryptos, things like that with good liquidity, I like to follow the rule of letting my winners run long and cutting my losers short. So for those things, I'm going to stay long. I stay long until the market switches because they're easy to get out of. And when the time comes, when the market switches, I can get out of them because of good liquidity. But for other investments, let's say like real estate, private equity, things like that are more long-term investments and they're not easy to get out of, then depending on how you feel, you might need to start moving sooner than later because you don't want to get caught. All right. Now, I know this might not be the answer you want, but it's the honest answer that you need. Now, let me know what you think. What probability or percentage do you give us for a big crash next year or that we continue higher? Leave me a comment down below. What percentage of probability do you assign for a crash or that we continue higher? Give me a thumbs up on this video if you like it. If you don't like the video, give me a thumbs down. It's okay, but leave me a comment and let me know why. I try to answer as many comments as I can, at least for the first couple days. And that's what I got for you today. All right, to your success. I'm out.